When it comes to the economy, which is what investors really want to know about, what did we learn from the markets this week on the economy?
So, if we start with today and the jobs number, I don't want to say on the surface it was strong. I think there was, you could nitpick a little bit with the average work week down, as you mentioned, David, wages coming down. But I think that the shift in the market maybe had less to do with some change in outlook for the economy, because you just sort of, for whatever reason, saw speculative juices sort of kick in again, the leadership back in those highly speculation driven, lower quality segments of the market, which at this point looks a little bit more like your typical bear market rally where you see just some counter trend moves versus some new assessment of either the inflation or the economic landscape. And I'm not sure the jobs data changed that to any significant degree either.
So Ellen, what about from your point of view as an investor here? Is it time to say maybe there is an area for a bear market rally, or is this just a tiny blip?
I believe, the real earnings hit will come in second half as we're hearing from companies, especially retailers, saying they're already seeing weakness from consumers. And I believe this is a tiny blip. Rates are up. Investment sentiment is down, and consumers, especially to the middle to the lower level of income level, they're getting squeezed, and we're already seeing consumer down trading today.
Lizanne, what about the consumer? It's pulled us through so many times before. It's such a large portion of the U.S. economy. Can we count on the consumer yet again?
I don't think so. I don't know that we see a significant implosion, but what you're seeing in the data already is a slowdown in demand, a slowdown of spending, especially in the stay-at-home area, the goods-oriented side of the economy, which if there's a silver lining, that bodes well for those components of metrics like CPI and inflation, because that was the breeding ground for the inflation problem with which we're still dealing. So that's a positive sign. There's this debate out there about excess savings and the strength of household balance sheets. David, we talked about that earlier today. And the only rub with that analysis, if you do it in the aggregate, it doesn't pick up the fact that most of that, call it excess savings, is concentrated up the income spectrum. And that's where the wealth effects of the net worth decline, courtesy of the bear market, as well as housing, comes into play. And then you look at the lower end and you see the increase in revolving credit. That's not a good sign when just to fund your day-to-day expenses requires taking on a bit more credit card debt. So I think the surge that was represented by the consumer and the economy coming out of the lockdowns, I think that's very much in the rearview.
Ellen, what about the component parts of the spending? Because coming out of the lockdown, as Lizanne was just talking about, it was mainly goods. Are we seeing services spending now really pick up the slack and maybe carry us through?
I think, we heard from companies like Walmart and Target saying the merchandise side of sales have, turned the other way. And in terms of services, we're also seeing a lot of travel cancellations or, a lot of congestion at airports, meaning there is still service demand on the services side of consumer demand. Yet, that's something that can turn very quickly. And I think the other, we had a good jobs report today, but unlike 3 months ago, we're also seeing headlines, companies, especially in the tech side, are, eliminating jobs. So I don't think, things are, we're in for a more difficult time for sure. And going back to, your question about how consumers are doing, we're also hearing from retailers how they've actually stocked up inventory during a time when demand was starting to fall. So I think from a corporate earnings perspective for a lot of these retailers, we're going to see a squeeze, and that's not going to be really pretty at all.
And David, Ellen makes a good point about the demand side of the equation and payrolls. Payrolls are a coincident indicator. And I think especially given the potential inflection point we sit in, we have to start looking at those, not even just leading indicators like unemployment claims, which on a 4-week average are up almost 70,000 from the low, but the leading indicators. And that's where you're starting to stack up more than just anecdotal evidence, whether it's the announcements of hiring freezes, job cut announcements, all of those happen before you get the pickup in claims, which in turn then leads to the downfall in payrolls. And the last thing to sort of fall or rise in the case of the unemployment rate are those lagging indicators. And I think that may suggest that we may be in this sort of final window of pretty strong payroll numbers if we continue to see that evidence stack up.
So listen, let's be honest. Sorry, go ahead, please, Ellen.
One other thing I wanted to add is, we're talking about inflation. Maybe energy prices are starting to flatten out a little bit and control over inflation may start. But I think another concern that I have is housing costs tend to lag from the period of interest rate hikes. So, taking into account shelter costs is a big component of the price index. That's another pressure that's going to still, continue to weigh in on consumers, again, putting more pressure on consumer sentiment and wallets.
Lizanne, one of the reasons we look at all these numbers so carefully is to try to figure out what the Fed is likely to do. Is the path of the Fed over the next 2, 3, 4 months basically baked in? And particularly, let me ask you, we got CPI numbers next week, we got retail sales numbers. Is that likely to change the Fed's mind?
So I think 75 is almost assuredly baked in for the July meeting, and probably either 50 or 75 at the September meeting. But that trajectory and how the markets are pricing in, whether it's 50, whether it's 75, will be somewhat dependent on the data we get between the July meeting and the September meeting. And there's another payroll report, there's the inflation data. And I would expect that you would have to see not just an easing in inflation, but the combination of an easing in inflation and deterioration in the labor market that forces the Fed to put now their focus on both of their mandates. Right now, they are almost solely focused on the inflation mandate. But if we saw that improvement in inflation, deterioration in the labor market, they may have to sort of temper some of the more hawkish language. But I think it would only be if the combination of those things happened.
Ellen, Lizanne makes such a good point about the tightness in the labor market, and it takes me back to the question about recession. Been a lot of talk about the danger of recession over the next year or 2 years even. At the same time, I'm not sure we can have a recession with full employment. Given the tightness, should we really be thinking about recession at all?
I think it is totally relevant to talk about recession because, as Lizanne said, in terms of payroll numbers, I do agree with her assessment. We're sort of at the last point. And just as I mentioned before, companies, as demand falls, they will tighten and, tighten their headcount as well, which means that I don't think the job market is going to be as robust as it is today. And hence, when a full recession does come, it will be driven by the fact that there's slower growth and people are losing jobs. And that's going to really accelerate inflation coming down, at which point the Fed will have to focus on an employment number as well as inflation.
And David, if you go back and you look at all modern day recessions and you look at where payrolls were at the start of the recession, which of course doesn't get dated until well after the fact, but the nature of how recessions are dated, the NBER, when they declare we're in one, in order to date when it started by month, they go back to the peak in the aggregate data they track, including payroll. So in fact, if you look at even the back-to-back brutal recessions in the early 80s, the really tough mid-70s recession, payrolls were not only high, they continued to rise in the early part of the recession. And the average increase in the unemployment rate heading into a recession is only 0.3. In fact, if you look at a chart of the unemployment rate, it's always at or near its low point at the start and at or near its high point and typically still rising at the end. So you just have to understand the whole notion of peaks in the data. We don't know now that we're at a peak, but you ultimately get to that point and then they backdate the start to the peak.